If you've been watching the markets even casually this week, you've probably felt it in your gut. Something big is happening. Gold just ripped above $5,500 an ounce. Silver's hovering around 115. And this didn't build slowly over years. It accelerated in days, maybe hours. And if you're wondering, is this already over? Did I miss it? Stay with me, because the real story isn't just the price. The real story is why this move is happening right now, what it tells you about risk, and how you can spot these setups before they go mainstream. I'm going to walk you through it like we're sitting across a table, watching the tape together, because once you see the mechanics, you can't unsee them. And if you're watching this right now, you're already ahead of most people who will only read about this in headlines 3 weeks from now. Before I explain what actually triggered this, let me teach you something most people never get taught about markets. Price doesn't move first because of headlines. Price moves because of positioning. Think of markets like a crowded theater. Everyone's comfortable, everyone's seated, until someone smells smoke. The exits haven't changed. The doors are the same size. But suddenly the crowd's behavior shifts. That's what safe haven assets are about. Gold and silver don't just go up because they're shiny. They go up when you and millions of other investors decide you'd rather hold something outside the financial system than stay exposed to it. And here's what you need to understand. Once that psychological shift starts, it can feed on itself faster than you expect. It's not linear, it's exponential, because every person heading for the exit makes the next person more nervous. So what does that tell us? It tells us that by the time you see the move on social media, the smart money already repositioned. They smelled the smoke while everyone else was still watching the show. If this is making sense, drop a comment below and let me know you're following along. I want to know who's actually paying attention. Now here's what's actually happening under the surface. Let me break down the sequence the way I see it. The primary driver is a sharp increase in perceived geopolitical and policy risk. Renewed U.S. tariff actions, including higher tariffs on South Korean imports, and broad tariff threats aimed at Canada and other trading partners, are not just political theater to markets. They're signals. When you see aggressive trade policy reemerge, investors immediately start pricing in slower global growth, more fragmented supply chains, and higher inflation risk. That's the first domino. Think about it. If you're running a multinational company, and suddenly your supply chain costs are jumping 20% because of new tariffs, what happens? You pass those costs on. Prices rise, margins compress, growth slows, and investors watching this unfold start asking themselves, where do I want to be positioned if we're entering a stagflation environment? Not stocks. Not bonds that are getting crushed by inflation. They start thinking metals. They start thinking real assets. That's the mechanism. That's the first wave. The second domino is the US dollar weakening alongside this uncertainty, because capital starts looking for alternatives. When policy becomes unpredictable, when trade relationships fracture, confidence in the reserve currency starts to crack. And when the dollar softens, gold and silver become mechanically more attractive worldwide. If you're sitting in Europe or Asia and you're watching dollar weakness, suddenly gold priced in your local currency looks cheaper. That creates demand. That creates buying pressure, and that feedback loop accelerates the move. So now you've got two forces working together, geopolitical risk pushing people towards safety, and currency dynamics making that safety trade more attractive globally. That's not random, that's structural. Here's what's wild about this. These two forces aren't just happening at the same time, they're reinforcing each other. Risk-off flows push people toward metals, which pushes prices higher, which then attracts momentum traders, which validates the move, which pulls in even more capital. That's the cascade. And when you see both fundamental fear and technical momentum line up, you're not looking at a random spike anymore. You're looking at a regime shift. But here's the part that should make you pay closer attention. A lot of mainstream investors still aren't positioned for this. You can see it in institutional allocations, in commentary, in how surprised people sound on TV. When the crowd is still catching up while price is already accelerating, that's when moves can stretch much further than logic says they should. I've seen this movie before. The late arrivals always underestimate how far momentum can carry a move when the fundamentals are actually backing it up. This isn't just technical froth, this is real money responding to real risk. And there's a third layer most people aren't talking about yet. Central bank behavior. When you've got tariff uncertainty and inflation risk rising simultaneously, what's the Fed's playbook? They're trapped. If they tighten to fight inflation, they crush growth. If they ease to support growth, they validate inflation fears. Either path is bullish for gold. You're watching a scenario where the central bank's credibility is being tested, and metals historically thrive in that environment. So you've got geopolitics, currency weakness, and monetary policy uncertainty all converging at once. That's not one catalyst. That's three major structural drivers firing together. When that happens, the market's telling you something important. It's telling you the rules are changing. Now, this isn't a new script, by the way. This is the exact same playbook markets have used before. Look back at the 1970s, when inflation fears and geopolitical instability pushed gold into a multi-year run that few believed at the start. At the beginning of that decade, gold was $35 an ounce. By 1980, it hit over 800. People thought it was crazy at 200. They thought it was a bubble at 400. But the fundamentals kept pushing it higher because the underlying conditions, inflation, currency instability, geopolitical chaos, didn't resolve, they intensified. Or look at the period after the 2008 financial crisis, when trust in the system cracked and gold climbed relentlessly, while commentators kept calling tops. From late 2008 through 2011, gold went from under 800 to over 1900. Every pullback was bought. Every rally was called unsustainable. But what was actually happening? Massive central bank intervention, zero interest rates, and a crisis of confidence in the financial system. Sound familiar? More recently, during the pandemic shock, when massive policy intervention and uncertainty drove a surge into precious metals, we saw the same pattern. Gold went from 1,700 to over 2,000 in months. Silver doubled. The setup was systemic uncertainty plus monetary expansion. Every time this combination shows up, rising systemic risk plus weakening confidence in fiat currencies, the pattern repeats. Zoom out and you see that gold and silver don't just move on emotion. They move on cycles of trust and distrust. The larger story is this. When people start questioning the stability of the rules themselves, they reach for assets that sit outside those rules. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be a blow-off top? Absolutely. Markets overshoot. Hype exists. There are always players trying to manufacture excitement to dump into strength. And yes, precious metals markets have a long history of manipulation claims, exaggerations, and bad actors. I'm not here to sell you a dream. I'm here to show you the mechanics. Could this rally fade next week? Sure. Could profit-taking kick in and send prices back down 20%? It's possible. But here's the thing. It doesn't actually matter whether there's some shadowy conspiracy or whether this is pure market forces. The mechanics are what matter. Focus on what you can control. You can watch price behavior, you can watch volume, you can watch whether pullbacks get bought aggressively or sold into. You can watch whether the narrative is expanding or contracting. That's actionable, that's real. The conspiracy theories are entertaining, but they don't help you make decisions. Data does, structure does, patterns do. There are probably three types of people watching this right now. Maybe you see yourself in one of them. The first is the person who already owns some gold or silver and feels vindicated. You did your homework early. You bought when it was boring. You held through the sideways grind. And now you're watching your position finally wake up. You're probably wondering, do I add more or do I take profits? Here's my honest take for you. Define your plan while you're calm, not while you're euphoric. If you bought for fundamental reasons, and those fundamentals are strengthening, there's logic in holding. But if you're feeling the urge to double down just because price is ripping, that's emotion. Set levels. Decide in advance where you'd add, where you'd trim, and stick to it. Don't let greed override the discipline that got you here. The second type is the person who feels late. You're thinking, I missed it, didn't I? You're watching these moves and kicking yourself for not buying 6 months ago. Let me be honest. Chasing parabolic moves blindly is dangerous. Buying the absolute top because you can't stand watching anymore, that's how people get hurt. But learning the structure of the move, waiting for controlled pullbacks, and scaling in thoughtfully, that's very different from panic buying. If the fundamentals I just walked through are real, this isn't a one-day event. There will be consolidation, there will be opportunities. Your job isn't to catch the bottom. Your job is to understand the trend and participate intelligently. Don't let FOMO make you reckless. The third type is the skeptic. You think this is all noise, all hype, and you're waiting for it to crash so you can say, I told you so. Your caution is healthy. Seriously. Skepticism protects you from a lot of bad decisions. Just don't let disbelief turn into blindness. Even if you never buy an ounce of gold or silver, understanding why these moves happen will make you a sharper investor everywhere else. You'll recognize risk-off flows. You'll spot currency dynamics. You'll understand how positioning drives price. Those skills translate, and here's the universal principle for all of you, no matter which camp you're in. You don't need to predict perfectly. You need to observe clearly and act consistently. The people who win in markets aren't the ones who nail every top and bottom. They're the ones who recognize the structure, manage their risk, and stay disciplined. So here's what I want you to answer in the comments. Which type are you? Are you holding and trying to decide your next move? Are you feeling late and looking for entry? Or are you skeptical and watching from the sidelines? Be honest. I read every comment, and I want to know where your head's at. Now here's where I stand. I'm not a gold maximalist, and I'm not dismissing this as a fad. I'm watching the structure. First, I'm watching how gold behaves on dips. Do buyers step in quickly, around 5,300, 5,200? If dips get bought aggressively, that tells me there's real demand underneath this move. If we see weak bounces and heavy selling, that's a different story. Second, I'm watching the dollar. If weakness continues, especially if the dollar index breaks below key support, that's fuel for this rally. If the dollar stabilizes and starts bouncing, that could cap the upside. Third, I'm watching policy headlines, especially around trade and geopolitical risk, because that's the emotional engine behind this move. If tariff rhetoric escalates or if we get new geopolitical shocks, that validates the safe haven bid. If tensions cool, the urgency fades. The way I see it, this rally wasn't random, and it wasn't just emotional. It was structural, mechanical, and psychological all at once. You had real policy shifts creating real uncertainty. You had currency dynamics amplifying the move. And you had momentum confirming the trend. That's a powerful combination. The fundamentals aren't screaming all clear. They're validating caution. And if history rhymes, periods like this tend to reward the people who stay curious, stay humble, and stay engaged. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. But if you made it this far, you're the type of person who thinks critically and wants to understand the game, not just react to it. That mentality will serve you well. If you found value in this breakdown, share it with someone who needs to see it. Subscribe if you want more real-time analysis without the hype. And remember, the market doesn't reward predictions. It rewards preparation. Stay sharp out there. Think critically, verify what you hear, and always make your own decisions.